You wake up one morning, you check your account. Your local currency has lost nearly 40% of its value overnight. Not slowly, not in years, in hours. Banks are frozen, ATMs empty. Prices have doubled. People are panicking, and no one seems to understand why it happened, or if it could happen again. Currency crashes are often presented as chaotic, random disasters, but the truth is far less glamorous. They're engineered almost inevitably by the very systems we trust to protect our money. Behind the headlines and social media outrage lie mechanisms, mathematical, psychological, and political, that almost guarantee some currencies fail while others survive. Today, we're peeling back the curtain. We're going to see the hidden mechanics behind currency collapses and why most people never notice them until it's too late. Let's start with a basic question. What is money? Not coins, not bills, not even digital balances. Money at its core is a shared belief system. It only works if people trust it. That trust is fragile, and it's exactly that fragility that makes crashes possible. Imagine a small country. Its central bank prints more money than the economy produces. On paper, this sounds like a growth strategy. We need more liquidity, economists say, but in reality, it's a slow leak in confidence. Prices start to rise. First, subtly. Bread costs a little more. Rent ticks up. People shrug. Inflation seems normal. Then comes the tipping point. Confidence wobbles. Foreign investors hesitate. Suddenly, anyone holding that currency starts asking, is it worth keeping? This is where the first hidden mechanism kicks in. Speculative runs. Speculators aren't evil geniuses lurking in dark rooms. They're traders who detect signals before the public does. They see government debt rising. They see reserves shrinking. They notice political instability. They calculate the probability of a devaluation. And they act fast. They short the currency, borrowing it at the current value to sell, hoping to buy it back cheaper later. And here's the cruel irony. The act of speculating accelerates the collapse. Every sale weakens the currency, which confirms the speculator's prediction. It's a feedback loop, a self-fulfilling prophecy. But that's just the beginning. Currency crashes are rarely the result of one mistake. They're the intersection of debt, policy, and human psychology. Let's talk about debt. Countries borrow in two main ways, domestic and foreign. Domestic debt is owed to your citizens. Foreign debt is owed in dollars, euros, or another strong currency. When a government borrows abroad, it's betting that its own currency will remain stable or strengthen. If it doesn't, things get ugly fast. Because here's the math most people never see. If your currency drops by 50%, your foreign debt doubles in local terms. $1 billion loan suddenly becomes $2 billion. Overnight, governments that seem solvent are suddenly insolvent. And when a government teeters on default, confidence evaporates. You've probably noticed the pattern by now. Crashes are not accidents. They are predictable, given the right conditions. Yet most people only learn about them through panic headlines. Let's zoom in on a classic case. The 1994 Mexican peso crisis. Mexico had a fixed exchange rate, pegged to the dollar. For years, it borrowed in dollars, confident its exports and reserves would cover obligations. But as political instability grew, investors began to worry. They sold pesos, bought dollars. The central bank tried to defend the peg, spending reserves. It failed. Within months, the peso lost nearly half its value. Inflation spiked. Interest rates shot up to 50%. The economy contracted, and this domino effect rippled through Latin America. Notice the pattern? Pegged currencies are fragile. Any small shift in confidence can trigger outsized consequences. Now consider a more recent example. Turkey. For years, the Turkish central bank resisted raising interest rates, even as inflation soared. Political pressure trumped economic logic. Investors lost confidence. Foreign debt ballooned. The currency collapsed. Ordinary citizens saw their savings evaporate. Meanwhile, headlines often framed it as a mystery crash rather than the outcome of predictable policy failures. And yet some currencies survive similar pressures. Why? Because currency value is not just numbers on a balance sheet. It's credibility, reserves, governance, and sometimes sheer luck. The Swiss franc, for instance, benefits from decades of stable policy, deep reserves, and an unshakable reputation. Investors trust it. Even global crises tend to strengthen it. This introduces the second hidden mechanism: perceived credibility. Markets do not respond to what governments say. They respond to what they believe will happen, and belief is shaped by signals, past behavior, and psychology, not just hard numbers. A government can print more money, but if investors trust it, the impact is limited. If that trust erodes, the same action can trigger chaos. And here comes the uncomfortable math most media glosses over. Crashes are often exponential, not linear. A 5% drop in confidence can lead to a 20% drop in currency value. Another 5% drop can trigger a 50% collapse. It's a chain reaction amplified by leverage, derivatives, and high-frequency trading. Speaking of leverage, this is where things get really interesting. Modern currency markets are highly interconnected. Hedge funds, banks, multinational corporations all hold massive positions in foreign currencies. They borrow to amplify gains. They hedge to reduce risk. But this system is like a loaded gun. One trigger can set off a cascade. Think of the 1997 Asian financial crisis. Thailand's baht was overleveraged. Once investors started pulling out, dominoes fell across Indonesia, South Korea, Malaysia, and beyond. Local governments tried to intervene, but the sheer volume of capital moving in and out was impossible to counter. Entire economies were reshaped in months. Here's another uncomfortable truth. Crises often start slowly, almost imperceptibly, but end violently. They're like a pot of water gradually heating. You don't notice the danger until it boils over. And yet public narratives often miss this. Media focuses on the explosion, the hyperinflation, the bank closures, the riots, while ignoring the years of buildup, the subtle cracks in policy, the misaligned incentives. Which brings us to irony number 2. Most currency crashes are preventable, yet unavoidable in hindsight. Economists, traders, and central banks often see the signals, but are constrained by politics, incentives, or sheer cognitive biases. By the time the public reacts, the crash looks sudden. Let's talk about incentives for a moment, because this is critical. Politicians often prioritize growth and popularity over stability. Central banks may face political pressure to keep rates low, even when inflation is rising. Private investors seek short-term profit, sometimes at the expense of systemic risk. Everyone behaves rationally in isolation, but collectively, these choices accumulate into disaster. And yet, despite all this, humans behave as if crashes are surprises. We forget that numbers are human decisions. Every currency collapse is the result of policies, misjudgments, and market psychology converging. It's not fate, it's math, magnified by trust or the lack of it. Here's the final mechanism, and it's the most subtle: social feedback loops. When ordinary people sense trouble, they start withdrawing deposits, buying hard assets, moving money abroad. Banks tighten lending, businesses cut production, the economy contracts. Confidence drops further, the currency falls more. What started as speculation becomes a self-perpetuating spiral. Ordinary behavior amplifies what began as elite financial calculations. This is why crises often hit hardest at the ground level. Inflation becomes visible in supermarkets, fuel stations, and rent payments. The abstract math of debt and interest rates suddenly becomes existential reality. And here's a darkly fascinating part. The bigger the hype, the faster the collapse. Economies intertwined with global capital can sustain a bubble for years, but when perception shifts, the fall is spectacular. So what should we take away from this? First, currency crashes are not random acts of God. They are predictable, given the right mix of debt, policy errors, speculation, and human psychology. Second, the real drivers are often invisible to ordinary observers. Leverage, credibility, confidence, and feedback loops. Headlines only capture the tip of the iceberg. Third, the consequences are real, immediate, and deeply social. When a currency collapses, it's not just numbers that vanish, It's people's livelihoods, savings, and trust in the system. Finally, the big question looms. Can we ever design a system that fully prevents currency crashes? Or are they an inevitable part of human economic behavior? A recurring fracture in a system built on trust and collective belief? History suggests they're unavoidable, but understanding the mechanics gives us a choice. We can react intelligently, prepare, and maybe even exploit the cracks. Or we can remain blind, waiting for the next headline to shock us awake. Because in the end, the most uncomfortable truth about currency crashes is this: they are not chaotic, but they are inevitable, and the clock is always ticking.